In this video, traders, we're going to answer the question, can you go into debt Forex trading? Hey guys, warm welcome to you. So question from viewer or subscriber, appreciate all your questions and support. Thank you very much, ladies and gents. I don't know, majority of you are gents, but there are some ladies out there who watch these videos as well. So good stuff. Right, so can you go into debt Forex trading? This, I've kind of taken this question and put my own kind of perception on it, if you like. So what I'm not looking at the question is, can I end up borrowing money on credit cards and loans? Well, the obvious thing is yes for that. So I'm assuming that's not the question. The question is, can I go into debt, i.e. I've got a position on, let's say I'm long and the market is chugging along very nicely and all of a sudden it slams to the downside. Can I go into debt with that? Now, the thing with Forex trading, as we know, is that we're trading with quite high leverage or margins. So we're trading like 50 to 1, 100 to 1, 200 to 1, some kind of... Now, I recognize now with the new ESMA rules, this might be redundant in the UK, but this still super important, guys. So new ESMA rules basically say if you're trading in the UK a spread betting account, then you can't lose, if you're a retail trader, i.e. you're not professional status, you can't lose more than you have in your account. So you've got a negative balance protection. Now, you must check that. You must check the provider you're using has that, as it all covered and is regulated and all this kind of stuff. But generally speaking, ESMA rules state that. So this may be redundant for that. However, let's look at it from perspective if that didn't exist, if you're trading perhaps in another country, if you're trading not under ESMA rules, if you're trading unregulated, you're just trading in general. Okay, so the question is, can you go into debt Forex trading? Let's say you're long, you're leveraged up and the market goes against you. So there's a couple of things that can happen here. So number one is, if you're super leveraged up, a small move against you means it's going to wipe out your account, right? If you are as maximum leverage and the broker is allowing you a lot of leverage, you might find that a relatively small move, a day's range, even 100 pips, 200 pips, wipes you out. If that happens, most of the time what will happen is this. If the market is coming down, let's say the market is chugging and it comes down and you're highly leveraged up here, you've made a long trade, full margin, and it starts to tick back down. When it gets to this point here, the majority of brokers will send you a message saying you've got a margin call, you need to put more money in. When you don't, say it's there. When you don't, it's here, they will start to liquidate your position. They will probably reduce your position. So they'll take half off or whatever it may be. And then when it gets to here, they'll take more off. So in reality, again, the shortcut is if you left it all the way, you would end up with nothing in your account because the broker would automatically, or most brokers would automatically take you out of the position because they want to protect themselves, right? They want to be on the hook to chasing you for money. They take you out of the position or close the position smaller until you wait and run out and then lock you out completely. So that's on a kind of orderly decline position. You would not, generally speaking, you would not go into debt without the broker would have you out straight away. Now, there are some brokers that, very few these days, but some brokers who don't have the automated process in place, and they would say in the terms and conditions, even in ones that are automated, listen, and again, forget about ESMA for now, they would say in the terms and conditions, listen, if you go, we're not responsible for closing you out of a position if it's wrong. It's up to you. And there are some brokers who may not have the automation. Perhaps they're white labeling another software. Well, not necessarily white labeling. Perhaps they are leveraging on the back end of another software, but not the front end. You get the point. They're driving low. You may not get a phone call. You may get a phone call here, it might not be automated, and says, well, actually, you're on the hook now for a couple of grand, Mr. Smith. You need to pay it up. So, but generally speaking, that's very unlikely. Generally speaking, under the orderly decline, if you're long, or orderly rise, if you're short, you're going to be stopped out eventually with no money in your account and you're not going to go into debt. However, let's look at this scenario here, which we saw not too long ago, actually, with the Swiss. The brief or the savage decline, the quick decline, or the gap over Sunday night. So a gap from kind of Friday to Sunday, Forex doesn't trade on the Saturday. That time period could result in the significant price move. Let's say some crisis happened in Europe and you're trading euro, then the close would be here on Friday, and then Sunday night it might open down here. You might gap lower. Now, if you are margined in that situation, then you would be on the hook for the extra you've got. So let's just say, for argument's sake, All right, let's just use this as a thing. Let's say that's £1,000 worth, $1,000 worth of move. Whatever you've got in margin, so whatever your position size is, that's worth 1,000 to you, okay? And you've only got 1,000 in your account. So theoretically, that's your 0 point. If the market is gapping and opening up here, or moving so quickly, we'll get to that in a second, or moving so quickly there's no trade done, and the next print is kind of here, you would be, and that's $1,000, it says $1,000 worth to you for your position size, you would be having to pay that to your broker. You would go into debt into your broker. Your account balance would be minus 1,000. Now, assuming they close you out here automatically because that was the first print, you would then have to pay that $1,000 difference because that's your position that went against you. That was the first opportunity you got out. Now, if we talk about markets that move quickly, that's what we saw with the Swiss as well, is that it was moving so quickly. It wasn't a gap as such, but the prices were so, with your market, a few people with market orders were taking out all the prices. The next available price was here. So it was almost like a gap. You were on the hook for whatever position size you had on, multiplied by the amount of pips that it moves against you. So you can go into debt Forex trading if you're holding stuff and it gaps significantly against you, or it moves significantly against you very, very quickly. So be mindful of that. So how do you combat that? Well, the first thing as we go back is to trading something that has negative balance protection. Either if you're trading through ESMA, or some Forex brokers will offer that. They'll offer services, i.e. you can have a kind of different level of account where you pay a bit more spread, and they'll give you a guarantee that you'll never go into negative balance. You can have guaranteed stops, which again will always guarantee you get stopped out. So again, you can set those so you never go into a negative balance. There are things you can do to combat that, but the biggest one, guys, which is going to help you with the trading generally, is just not being so leveraged up, being able to stomach kind of some decent, I mean, this would be a very bad trade if on the normal move in the market you lost all your money in your account. These things are rare, they do happen from time to time, but again, even if you're not super leveraged, it shouldn't hammer you that much. It's going to be a big blow, don't get me wrong, and a lot of people on the Swiss got caught out significantly with it, but it shouldn't be that it absolutely decimates your account. So reducing the margin that you're using, reducing the amount of leverage you're using is a big one, but then also checking that you're trading through a broker, either whether you're trading through ESMA, if you're trading from another country, just saying, okay, what is my negative balance protection? Do I have any vehicles or stuff that I can do? And also the final thing is being mindful for what you're trading. So a lot of people who are trading the Swiss, and I'm not necessarily blaming them or pointing fingers, but weren't aware that that was the kind of event risk or fat tail black swan risk from trading that. It's like if you're shorting a stock that has been rumors of a buyout, you should know that that next day you could wake up and that buyout has come true. And so it's maybe staying clear of anything that has got that tail risk. It's doing a research on the vehicle or the market you're trading and saying, well, you know what, there is some hidden risk in that. I don't think I'll trade it because even though it's slim, I don't want to be exposed to it. So anyway, guys, can you go into debt with Forex trading? Yes, under some circumstances, you can. Take care. Bye-bye.